I wanted to talk about the 22 MFR market force recognition indicators uh, without without going to a chart and explaining things. I just wanted to make you aware of what they are, what they can do, and why they're used or how they're used. I'll start with the price, the three price lines, and I'll obviously be bouncing back and forth because of different attributes and conditions in different lines that are the same, and that starts right here in the price chart. The red, green, and blue are what we refer to as price barometers. They track the price. They go identically with the price. When the price is up, the lines are up. And when the price is down, the lines are down. That's very powerful information that can be utilized quickly when it needs to be. Swing Zion and Zip Pink are the other two price barometers, and they were placed on the other charts for specific reasons, but one of them obviously is to identify the actual direction of price quickly. And so those five are basically our price barometers. On the we have an indicator in radar screen built that identifies when a indicator is above zero or under zero, when it crosses over or crosses under each other, and obviously when it goes up or down. And on that indicator, by definition, when you cross over something, for example, you're on a peak and price red is highest and it goes down and it says it crosses under green. Well, what that means then is that it ends up lowest. And so it started out on the peak highest, it crossed under green and went down lowest. It obviously and normally, when it's on a peak, goes down, but it remains highest when it goes down. It does not cross under. When it does cross under, it's a form of divergence. And divergence is one of the biggest factors inside of the system that helps us identify good, strong market force movements. And the reason I suspect is because the indicators are very sensitive. And because of that sensitivity, we get a lot more divergence in the indicators than what we might normally think of. That's hard to quantify, but it just seems that there is more because of that sensitivity. With that being said, when you do have a crossover, like for example, when price red is on a peak highest, crosses over, and it's under green, amazingly, not always, but amazingly, the price lines will point to the gap. So in other words, if it goes down, it's going to gap down next day. And vice versa. When the price lines have a crossover, they end up next day with a gap up. Now, obviously not in every case. In a lot of cases, you get a really nice candle because of the crossover divergent move. But the maximum height or range that the price lines get into, green will get up to 150. I've seen, obviously over the years, I've seen many examples of price green going over 150, but it very seldom in 1/100% of the time it does that. It just very seldom goes over 150. I've seen many days where it was at 150 and closed at 149. So when you find a position with a price green at 148 or 149, you are pretty much at the top. And if the supporting evidence dictates it, there's a really good chance that things are going to go down the next day, especially if it's been moving up slowly. The last 4 or 5 days it's been above 140 or 135 or whatever that number is. So price the price lines are a very powerful group of lines that help us out. Also, price green can drop under zero. Price red will too, but when price green drops under zero, and I emphasize that because most of the time when you have a downturn, price green is highest. And normally when price red is highest, it's just a few, 1 day or could be, 5 day up and then it's down. I have seen situations where price red remains highest, traveling for months at a time. And then all of a sudden it goes down and stays in its normal position of price green highest when it goes up. The price red and green separate themselves by about 80 or 90 points when you go into an uptrend. So when you see the three of them down in the bottom together and all of a sudden red and green jump 80 points, there's a really good chance that things are going to continue up, especially if the price didn't move a whole lot. And so you obviously don't know if you've got a trend going of 3 to 5 days or if it's just a 1-day move, and that can be identified through your supporting evidence. But the three price lines are very powerful in what they tell you. The zip red is the quickest line in the entire system. It moves first and foremost in the vast majority of the time. The second line that is very quick is swing pink. Those two by far are the fast lines. Both of them are leading indicators. Swing gray is swing red's partner, and it is fast as well. But many times you can see when you see a spike down and gray actually noses out underneath zip red, it's almost it's an extremely high probability that it's going to reverse back up because gray came out from under it. In other situations, you can see red spikes down and gray is 40 points above it. It's just uncanny how sensitive the indicators are. And it tells you things based on the supporting evidence that you have. The zip red line also, I'll point out, is the best or has the greatest line length movement of any indicators. Zip red can jump 30, 50, 70, 90 points. Many times I've seen it go from under 5 to over 95. And when it does, the next day red goes down, but the price typically stays up or goes up higher. But during that day, when it jumped 90 points, the price hardly moved. It's the next day that things really start happening. And so that's one aspect of line length strength, or that identifies the strength. And there's obviously many other things that do it. From a pattern perspective, you have a BOC pattern, which is a V-shaped pattern. The left leg going down is shorter than the right leg, so the right leg is higher, and we call that a BOC higher pattern. That has more strength, more power to it. The forces are pushing stronger on that turnaround day, because the BOC pattern is the very first day of the turnaround. And of course, you always want to be in your market, in your 20, looking at your 22 market force recognition indicator lines. You don't want to be looking at your long-term lines like your 3 short-term line groups, trend trio, or the trend trio, yellow, pink, blue, or power orange and green, or swing red and green. Those are your 7 lines. They make up 3 groups, and they identify the short-term trend. We want those. We need those. We created a master long-term trend line using an exponential average line, and yet the long-term trend identification issues are there. You need to know that. But short-term trends are by far more important to day traders. I mean, the short-term trend lines don't even pick up pullbacks and rallies like your fast lines, your trend red and your power red and your swing Zion. And of course, all of your lines in the zip chart are very fast, hence they got their name. And yellow and blue in the zip chart travel together. They're paired together when they have position attributes. When they're traveling, let's say, just basically flat and around 80 or above, you're in an uptrend. When they're traveling flat and underneath 20 or so, you're in a downtrend. But there's more to it than that. Yellow and blue normally stay together, 2, 3, 4, maybe 5 points apart, almost all the time. But then all of a sudden, blue will take off and separate itself from yellow a great distance. And when it starts that separation, you're going to get more volatility or higher candles in that separation, or bigger candles, depending on which way the line is going. And then when the lines come back together, you're going to get strong candle lengths as a result of that. You're going to get more volatility because the 2 lines come back together. Also, zip yellow and power yellow are your yellow twins. You may have heard me talk about them before. When zip yellow and power yellow are highest, and then they go down, you're in a downtrend. When zip yellow and power yellow are lowest and they're going up, you're in an uptrend. And when one of those lines disappears under some of the other indicator lines, technically the trend is over. You can obviously, or let me say this, on many occasions you can identify the end of the yellow twin pattern with other indicators on peaks or in cycle bottoms. So we don't always necessarily need to wait until the last minute, because you can have them 2 minutes after the open, those lines can disappear because the price went in the opposite direction. So I think most people tend to get out of a trade, excuse me, most people tend to get out of a trade at the end of the day. That's obviously, that's not always true, but sometimes that happens. Zip green is a indicator line that tracks the buyers in and out of the market. Technically, it tracks the trades in and out of the market. In and out of the stock. And so when zip green is at 0, there are very few people coming into the market, or in fact are leaving the market. The stock, excuse me. When Zip Green is at 100, there are a lot of people buying the stock. Or it could be a lot of trades being made by a few people. But in any case, there's a lot more money going into the stock. When Zip Zion, which is a grandfather to Zip Green, is at 0, there's a huge number of people getting out. And likewise, when Zip Zion is at 100, there's a huge amount of people or trades being made buying up the stock. Those two are calculating the trades going into and out of a stock. They technically are not recording forces or tiny pressure movements within the stock itself. And so recognize this, understand the importance of it. For example, when you have a pink-green bottom or a pink-green top, in the example of a top, you have Zip Green at 100, and maybe it runs along at 100 for 3, 4, 5, 6 days. In the majority of cases, all the time, Zip Pink is going to be climbing up each and every day and getting closer and closer to Zip Green. The requirement for the price to turn down in 90-some% of the cases is that Zip Pink must be next to Zip Green. Normally it's within 3 points, but it can be farther down, and it's highest. If, for example, red and Zip Yellow and Zip Blue, or even red and gray, pop up above pink and they hit 100, and then they go down and Zip Pink continues out, that is typically the day of the downtrend, the following day after that. Because why? Because the rule of the pink-green top is that pink needs to be highest and next to green before the downturn in the price occurs. And amazingly, that happens the vast majority, I mean, way over 90% of the time. There are exceptions, but once in a while, the price will go, you'll get a BOC in the Zip Pink line, but it'll come back up. We eliminate, or we exclude the Zip Zion when we're qualifying Zip Pink as being highest and next to green, because Zion is the grandfather, and we're really not concerned about the market forces. But we do want to identify and understand the pressures or the tiny forces in the market with the indicators, or mainly with the price as in the anticipation of its movement relative to the indicator lines. And so those lines are very important in understanding. Why? Because Zip Pink is your price barometer, and Zip Green is your trades in and out of the market. And you can see how the two of them are connected. And so when that occurs, you begin to understand, or hopefully see, that relationship between Zip Pink and Zip Green. And sometimes I treat them as a pair, but that's not exactly the situation. Zip Pink is rather independent because it tracks the price. So trend red is our best overall line. We watch trend red without a doubt the most. We determine what it's doing and see its reaction and respond to it. It is by far the line that we watch the most. The Trend Red, Power Red, and Swing Zion are your big three. The forces within those three lines, when they're combined together, for example, when all three are lowest, or all three are in a BOC pattern and lowest, they constitute a group of forces mixed together which typically identifies uptrends. And sometimes you'll get a pullback. You might get a one-day pullback in a 3 to 5 day uptrend, but it's amazing how often those three together, with the powers that or the forces that they represent, or the pressures that they represent, when they run in unison, they are very strong. You get good volatility in your candles. They can all be on a peak. They can all be in a low angle up on a peak or low angle down in a cycle bottom. But wherever they are, they run together, and each of them can act as a leading indicator. For example, sometimes you can get Trend Red down, Swing Zion down, and Power Red will be going up, and you'll be in a red candle. And sometimes that will gap a little. Sometimes you'll get a really big candle. Sometimes it's the start of 4 or 5 small green candles. But it's definitely the case of an uptrend, or sometimes you get 2 strong green candles and then it's over. But the important thing is that you recognize the big three, and you think of Trend Red in its relationship to the trio, the blue, pink, yellow lines. Those are drawn in a little wider, as are the Power Orange and Green and the Swing Red and Green. Those 7 are not part of the 22 market force recognition indicators, but they are very important in what they do. That's when we have the 7 short-term trend lines in a column indicator on the radar screen. So you can quickly look at, a red box indicates that the line is going down, and a green box indicates that the line is going up. And you can identify with which direction the trend lines are going. The trend trio moves faster than the other 2 groups, always. You'll see that the trio is just a quicker moving group than the other 2 lines. And so, also the Swing Red and never crosses over the Swing Green. They're 2 separate mathematical formulas, and they represent different ideas of what's taking place within the market, but they never cross over one another. Also, while I'm at that, on the trio lines, the blue, pink, and yellow, they obviously cross over each other. The yellow line is always closest to the 0 line, whether it's above 0 or under 0, but they all cross over 0 on the same day. It's an interesting set of lines, and it's very interesting from the perspective of, in the trend chart, from the perspective of the down touches or the up touches that we have, because it's the red, green, and gray that down touch the blue, pink, and yellow lines, or the 0 line, or underneath the 0 line, and the 6th down touch that you have is what we refer to as a sky touch, and we have to have one of those 6 occurring to have a gap. If you are not familiar with it, like I talked earlier, the 22 market force recognition indicator lines, the gap or the down gap in the trend chart. You have to have one in the trend chart. And you have then also the patterns, the location patterns in the proximity group and the shape patterns. Both. Normally you never have any trouble with the shapes, but once in a while the lines can get convoluted in an actual pattern from sense, which then makes it, you scratch your head and wonder if you've got a gap or not. But the best thing to verify is supporting evidence. If you have another pattern in the group, like the zip Zion is either lowest or highest, that's going to tell you which way the thing is going. The other great thing that'll tell you which way the gap is going is by looking at the price lines. If you're at 90 or 100 or way above, you know that it's going to gap down. But if you're way down low, then there's, there's an excellent probability that it's going to gap up. So also trend red, when it goes down and then it comes up and it crosses over green, that is the technical start to an uptrend. Many times when trend red does the BOC pattern where it starts turning and comes back up, many people consider that the start of the uptrend, and I got no problem in relating to that, but you can have weak starts if the red does not cross over the green. Whereas when trend red crosses over the green, unless it's running sideways, but as long as it's going up after it crosses over green, at a respectable angle, you then have that what we refer to as the cycle turnaround. And it's just like in the zip green and red lines, and you have the blue line. The blue line is not a member of the 22 market force recognition, the swing blue, excuse me. The swing blue is specifically designed as a crossover indicator. It crosses over the green line and then it crosses over the red line. The red line is always on top, swing red. But when swing blue crosses over the green line, you normally and not always, but you oftentimes can have a weak start when blue crosses over the green. A weak start to the uptrend. But when blue crosses over red and travels up above red, you're in a nice uptrend. And so, all those things to keep in mind. The power of the big three is phenomenal. And that's why my favorite divergence, my favorite pair of indicators in divergence, I guess is the best way to describe it, is trend red and power red. When those two are in a divergent situation, you get a really strong movement. And it's got to be the forces within the two indicators that are opposing one another and pushing against one another that cause the big movements. Because remember, we don't, who can define the forces within the indicator or within the market, within a stock? Because there's all kinds of equilibrium pressures, or should I say forces pushing on the equilibrium would be a better way of describing it. The market's always going to want to come back to itself and, run normal. But men or other situations, companies can get bad reports. The demand for the product can drastically change. Whatever might happen, there's obviously other forces out there, but those then reflect back into forces within the market. And the way the day trading visual basic system works is picking up on real tiny changes in the forces of the market or the pressures of the market, and we pick up those changes prior to the major moves taking place so that we can be in that position before others are in there. Because let me tell you, it's a great feeling to be in the position with the stocks or with the shares that you want, and people are just buying and buying and buying and buying. It's a great feeling. But you have to have a system, you have to have a method, you have to have a procedure, or I don't care what you call it, of getting there, as part of the top 5%, or however you want to look at it. That is one of the keys to effectively and consistently be successful in trading stocks. You need to recognize that. It's a case of identification. Remember, the DTVB was built on reversal recognition. We get the indicator line length strength issues out of that. We identify the conditions of the three patterns that let us know that gaps will occur. I mean, nobody out there that I'm aware of even has any idea about market strength or about strength of a stock, or even has the knowledge of recognizing that the turnarounds, the very essence of the turnaround is either strong or weak. The only thing they look at is the candle length and make a decision, and sometimes that's good and sometimes it's not. But people can't make logical or intelligent decisions on market strength with candles. It just can't be done. You have to have an ability to recognize different forces that are taking place and what those forces are doing. And we don't know what the names of those market pressures are, but we can see them move. And we can identify what they're doing based on historical data. And, realize that, when we trade, we're trading high probability trades every single time we trade. I mean, just by picking out a pattern and verifying its condition. I mean, if you picked out a pattern and didn't even verify the conditions, it's a better formula than what most people are doing. But when we grab a pattern and then we verify the conditions, it's just, you may have heard me say before, I use the example, take 10 opportunities, 2 of them will end up in nice green candles if you're thinking of a buy long situation. 5 or 6 are, small green or medium green candles. 2 or 3 might be reds. And you got basically a 20% high probability ratio generically as that pattern comes out of the system or as it's trading. You do it again a week later, you might find a pattern, maybe 3 out of the 10 will have long green candles. But the point is, those 3 had specific conditions. The short-term trend lines were in a specific location, or the zip yellow lines were in a specific location, or just a whole series of other lines specific to the patterns that we have. Keep in mind there's 20 pattern types up and, over 20 pattern types up and over 20 pattern types down. And so when we find gaps, we only use 3 out of those 20. the identical indicators, the down touches in the trend chart, and the proximity group patterns in the Power 4 or Power 5 lines, and how they relate in location and shape. Those are the three patterns that we use to identify gaps. And keep in mind, I mean, it's so, I don't know if sensitive is the word. It's when you take those three patterns, you cannot take those three patterns and then create another line and say, well, this is the line that I'm going to watch because that's what's going to identify the forces that move that stock into a gap. We can look at the forces in the identical indicators. We can look at the forces in the downtrend indicators. We can look at the forces within the location and the shape pattern of the proximity group. And when we do, we can see the gap, you know, especially with supporting evidence. And keep in mind, it's a little different each time, but if you looked at 50 of them, you'd have a much better handle on what I'm talking about. If you look at 150 of them, then you know what I'm talking about. And that's the difference. You know, the people in the stock market, your IRA guys, your financial advisors, they'll tell you you can't tell what's going on in the marketplace. And that's what everybody wants you to believe. But that is not the truth if you have the use of sensitive indicators and know how to use them. Because the system works fantastically. It is absolutely amazing. I've got to move forward here now. I'm going to talk a little bit about Power Pink, and you know Power Pink is a deep cycle indicator. It is what we refer to as a short cycle, whereas the swing gray, which is not a member of the 22 market forces. Remember, swing gray and swing blue, that crossover indicator with the swing red and green. The swing blue and the swing Zion are not part of the 22 market force indicators. Swing Zion is by far the best cycle recognition indicator we have. And it'll pick out and tell you where the top is and tell you where the bottom is. Swing gray. But it's a slow moving line. Sometimes it has a 1 day delay in it. But swing pink is also a deep cycle indicator, but is much faster in its recognition of cycles. For example, the swing pink can go from top to bottom almost, I mean, maybe not exactly, but really close. It can be highest 1 day and lowest a few days later, and swing gray will still be heading in the same direction. Because somehow swing gray identifies, and then sometimes identifies which way the trend is going. And then sometimes on the very same day that the fast lines, trend red and zip red and power red, when they turn down and you were on a high cycle and now you're going down, the swing gray will turn down that very same day. It's just something I haven't been able to figure out, but it is wonderful to have it as a line of information. Pink and blue are paired together. They sometimes, when you're looking at the location patterns in gap analysis, you'll see swing pink and blue, power pink and blue up and power white and yellow down. That's a great divergent condition. If you even got a few additional pieces of information of supporting evidence, you're likely to get a gap. and you can plug those into the scanner and find them. Remember, we have well over 400 indicators built. You plug in the indicator, you create your scan, and you go to the bottom where it says indicators, and you click on indicator, and it'll open up to all the indicators available to you. You can build your own, you can use the ones that TradeStation has built, or you can use DTVB indicators. And you can say, you can pick the one that says power pink up, and power blue up, and power white down, and power yellow down. You can plug in 4 indicators or more, all at the same time, and that scan will spit those symbols out on the day that they have the conditions that you define. You know, you might have some volume conditions or some price value conditions. Whatever it is, whatever you plug into the scanner, that's what you're going to get. So the pink, blue, white, and yellow are the power 4. If you take away the yellow, you have the power 3. If you add the Zion to power 4, you have the power 5. And if you add red to all of those, you have the power 6. As far as locations go on gaps, you can have the power 6 all above the power orange line. You can have the power 6 all under the power orange line. You can have Zion under and the power 4 above the orange line. You can have Zion under and the power 3 above the orange line, or vice versa. You can have Zion, then you can have directional divergence. You can have Zion down and the power 4 up. All of those location pattern, those are the location patterns. All of those location patterns work with gaps. Now, just because you have the location of one of those conditions, it does not mean it's going to gap. You still need to have the down touches in the trend chart, and you still need to have the identical indicators. And it really helps if you've got some supporting evidence of, you know, maybe a swing Zion, or I said that wrong, a zip Zion highest or zip Zion lowest, or that matches with the direction that the gap is likely to take. So additional patterns help other than the 12 or the 15 that you have already identified in the identical indicators. You can have one line movements. You can have leading indicators like swing pink going up, and all the rest of the stuff is going down. One of the other key types of divergence is the 3 trends, trend red, green, and gray. And it works where trend gray is in one direction and green and red are in the other direction. Oftentimes when trend red goes down and trend and red and green are up, you get a nice green candle the next day. It's obviously relative to your conditions, like on that day you would want your short-term trend lines flat or going up. If all 7 of them are going down and you want to buy into a up movement, I would question your sanity. But along the same lines, that's what happens when you have a gap, because oftentimes the lines are going down, but the elements of the 3 patterns and the supporting evidence tells you it's a case of the most amount of evidence wins. And the more evidence that you find, or excuse me, I should say the more evidence that's there, you might not see it and it'll still gap, but the more evidence that is there, the typically the nice strong gap movements we get. So divergence is a powerful element within the sensitive indicators of DTVB. And there's dozens and dozens and dozens of different types of divergence. You'll hear me talk about them on the videos and I really encourage you to listen to more. But I did want to put together something. This one's gotten too long, and I do want to end it. But the marks, I needed to put together a video describing the 22 market force recognition indicators and some of the key things that they did, and some of the elements that are helpful in recognizing how to use them in like the trend gray and red and green, or the other things that we know about. So thanks for listening. We will see you on the next video.